Time to ditch bonds? You're making a mistake, my friends. You are making a mistake. I'm telling you. The bond market. Let's dive into this a little bit. This is a great article from Hartford Funds. And look, man, I know some of you guys say, but you said don't buy bonds. You know what? 4 or 5 years ago. Well, I guess 4 years ago. This is my 5th year now on YouTube. Yeah, 3 to 4 years ago, I say no buying. Have cash instead. And now I'm saying differently. I wonder why. What could it possibly have happened over the last 3 years where I've changed my mind? And if you want someone who says the same, I've never understood this actually about politics either. Well, in 1992, you said this. Like, yeah, that was 30 years ago. I don't like people say I've never changed. So, like, if you never changed, that's not good. You want to change. As what the hell is this? Get new FaceTime? I don't. What am I getting? I'm just getting a note from my MacBook to update something. Like, I don't want that crap. Anyway, so let's read this thing on bonds. Conventional wisdom says to sell fixed income when rates are rising. In fact, let's take a gander at the 10-year right now. It hit 2% yesterday. I think it's still above 2 right now. Let's see where we're at. Yeah, 2%, 2.013. So 2% on a 10-year. You're locking in 2%. May I suggest that if inflation were a big concern, that the yield on that would be much higher than 2%. And what happens when the yields go up? The yields go up, the price goes down. And so you see a cratering in the price. The fact is hovering around 2%, which is up from where it was just a couple of weeks ago, but that's not indicative at all of a massive worries of inflation. It's just not. Expectation for rising rates would normally call for rotation away from duration-sensitive assets such as treasury bonds. Duration-sensitive means the longer terms in particularly. But nowadays it may make even more sense to add to duration. When equities are declining, holding some duration in a fixed income portfolio has historically served as a potential hedge that can allow investors to wait for rebound. Yep, I completely agree. And we're going to go to this great chart they show. While bonds tend to depreciate in value as interest rates rise, the opposite can be true for investors with longer time horizons. Bonds held to maturity will eventually be valued at par. So I just want to show you something here real quick. We go down here. Bonds are usually positive when equities decline. All right. So we got Q4, Q1, all these various quarters going back for the last 20 odd years. Average return in bad quarters, negative 12%. Average return for bonds are 2.74. So let's take our trusty board here. And what we're going to do is we're going to say we have 60-40 portfolio just for simplicity. All right. 64. Oh, man, don't tell me this is. Whew. All right, good. So we got, let me make myself bigger. Boink. All right, so we got 60-40 portfolio. So 0.6 is in stocks and 0.4 is in bonds. 0.6 stocks, 0.4 in bonds. All right, so bonds have averaged 2.74. This is going to be bad. I left my cap off this thing. And stocks have averaged negative 12.65. All right, so what we're going to do, I got 8,000 markers. A lady in Florida sent me a bunch of markers. I guess they're down to, oh, sweet, is it ready? All right, so that's how you do it. So we got 60-40 portfolios. 60% of our portfolios in stocks, which lost 12.65. 40% of our portfolios in bonds, which average 2.74. So we take our trusty calculator and we times 0.4 times 2.74. That gives us 1.096. We'll just say 1.1 for simplicity. So we average 1.1 we made because only 40% of our portfolios in bonds. Bonds averaged 2.74 during those rough times, which means we didn't make 2.74 because we didn't have 100% bonds. We only made 1.1. All right, then we got 0.6 times 12.65, and we averaged a negative 7.6% rate of return. All right, negative 7.6. All right. So what we do is we take that negative 7.6, subtract 1.1 from that. All right, so we got 7.6 minus 1.1, and we averaged a 6.5% down. The bonds gave us a little bit of up, right? And the stocks, while they got killed, they didn't get killed nearly as much because we only had 60% in them. Hope that makes sense. So we lost 6.5% over those quarters in a 60-40 portfolio, which is about half of what the S&P 500 did, if that makes sense. So again, what happened here is the bonds not only didn't lose value, they went up. And so it's not just a cushion against going down, but potentially have an upside as well. So it's a win-win in that regard. So yeah, we lost money, but we didn't lose. We lost about half of what a portfolio of 100% stocks would be, which is interesting because we only had 40% in bonds. I hope that makes sense. It's pretty a good thing to see. All right, so let's go down here. Bonds self-heal over time. I cannot agree with this more. I've done this 1,000 times this Sunday to show you how bond markets have done the following year after a loss. The self-healing feature of bonds may even be more pronounced with bond funds and ETFs, which are typically higher diversified with hundreds of issuers. Yep, 100%. So quarterly losses sometimes foreshadow strong returns. Historically, is all the time. Well, I don't say quarterly, but certainly annual losses. So here we are, Q1 2020. The bonds were down 3%. Q4 2016, 3. Q2, you can see all that. And what happened to the 12-month? They were up. So basically, Q4 2016, bonds were down 2.9. The following year, they averaged 3.54. 2004, they're down 2.44. The following year, it averaged 6.8. You can see that. And I've done that 1,000 times, like Ginnie Mae, the Vanguard Bond Fund, the Vanguard Bond Index. Let's just do that. Let's look at that again. All right, so we're going to look at the Vanguard Total Bond Index. And remember, the Vanguard Bond Index Fund, 70% of that, or if maybe even a little bit more, is government-sponsored entities like Fannie Mae, Freddie Mac, treasury bonds, which are not even government sponsored. They're literally government, Ginnie Mae. So this is essentially a significant government bond fund plus corporate bonds as well. So just keep that in mind. All right, so we're going to look at so we're going to see, let's see here. Hold on just a second. Return. So in 2018, it was down 13 basis points. 2019, it roared back. 2013, it was down. 2014, it roared back. 1999, it was down. 2000, it roared back. 1994 is down. 1995 roared back. You can see where I'm going with that. Off the top of my head, what was the Putnam Bond Fund, Income Fund? Let's see if we can. Hold on a sec. I'm using the Putnam Income Fund is because, as far as I'm aware, it's the longest bond fund that's been out there. I think its inception was like 1954 or something like that. So this has been around. So here we go. It's down. 2008 got smoked. 2009 it came back. 2015 it lost, basically 200 basis points. It came back. 2021 it was down. We'll see what it does and probably come back. 99 it got smoked. Well, it got lost. I wouldn't say it got smoked. And 2000 came back. 94 it lost. Then it smoked it in 1995. 1979 to 1980 got consecutive return negatives. I mean, that's 2%. Came back 81 and just crushed in 82. 73 and 74 again down about 10%. Crushed. I mean, you can see this. Now 1969 off the top of my head, I don't know what was going on there, but we got smoked and it came back, but it took a while to get back to where it was. So these 5 years right there were painful. 96, 66 lost. The next 2 years came back. 62 lost. The next 2 years it came back. Got smoked in 57, kicked butt in 1958. Now, can I say that's going to happen again? I don't know. No one knows. Interest rates are low. I get all that, man. I'm just, at the end of the day, that's why I own some Wellington. I bought Wellington because I said I want to make sure that if things go south quickly, I have a cushion, and the bonds are the cushion. But interest rates are going to kill bonds. I just want to see the evidence. Show me the evidence where that happened. When I say the evidence, I'm talking a 2-year time frame. Just show me the evidence, man. I'd love to see it because you're wrong, man. Now, could it happen? Anything could happen, man. My goodness. But we could all be speaking Russian because that evil Putin could be at our door ready to make us wear, those Russian hats. You know what I'm saying? Just anything could happen. And you can live your life that way. That's fine. I don't, but I do own some bonds now because I want that cushion for an inevitable market decline. That's going to be pretty bad in my opinion. All right. Love your thoughts. We'll see you